Hello and welcome. You're watching KYC. I'm your host Harsh Saita. Today we're going to talk about Axiscades Technologies. It's a very interesting company because it's into aerospace, it's into defense, and it's into semiconductors. And it provides services to all three of those buckets and therefore becomes a very interesting confluence in the current setup, both geopolitically as well as domestically. When you're looking at the overall context of things, you also have tariffs which could well impact the company if at all they are implemented, of course, and that's the other risk, and that's what makes it interesting. Now let's look at what I want to know about an Axiscades Technologies. The first one is, why is there no growth in FY25? They're guiding for extremely robust growth. They're in fact expecting revenue to go up by 8x in the next 4 years. Then why is it that revenue growth is sub 10% in FY25? That's my first question. The other one is, what makes them bullish all the way through FY30? What are the levers? What are the segments which are going to help it get from 1,000 crore in terms of top line to the guided number of 9,000 crore or near 9,000 crore by FY30? Really, that's the question I'm going to be asking. Where will orders come from? Why are they implementing a product strategy over a service strategy? How will margins go up from the current mid-teens number to 24% at least, is what they've said by 2029. What will drive that? And last off, is the FY26 number in terms of profit after tax of around 160 odd crore, is that achievable? I'm going to ask all of this. Of course, the vertical in terms of what will contribute to margins, and then you have your FY26. What are the goals? They've guided for 160 to 180 crore of PAT. What we've done is we've given it a far more conservative number. Listening to all of this, because it's going to be a very interesting conversation, I'm going to start off by helping break down what Axiscades actually does. And I did talk about the fact that it's into aerospace, it's into defense, and it's into semiconductors. So it's at a very, very interesting confluence. But let's start right from the very top. Let's unpack this. It's a tech solutions company, mainly focused on engineering solutions and services. It's listed since 2000. So it's done this for now 25 years as a listed entity. And that is the other thing that stands out for me. Let's talk about each of the verticals that it operates in. Aerospace. It offers design, manufacturing and support as well as aftermarket services to the aerospace industry. Now there are 3-4 manufacturers within the aerospace industry, so not too many, and this caters to all of those, so therefore helping the aerospace industry in a significant fashion. I want to also understand how deep are the moats, what's the competition looking like, and that will give us valuable insights as to whether it is the only game in town with regard to aerospace. Now let's talk defense. Defense is a big theme that's playing out domestically. They do custom build solutions on drones, mission critical systems and the like. I will break up all of those for you, but I'm just first spelling out what it does broadly. So defense is the other space. They do collaborations with the DRDO in defense. The focus is on defense electronics. They work with defense PSUs. Electronic warfare systems is what they help in. They do custom drone solutions. Mind you, drone is the big technology at this point. And they do custom drone solutions. They do armed drones. They do mission critical communication systems, among a lot of other pieces that they do with regard to defense. So again, something to look at. They also do homeland security, something like mobile command vehicles, AI video analytics solutions, etc. So think about the wide array that they cover in terms of defense, and it's looking quite impressive. And that's why I want to know, why just the 8% growth when you're doing such good work? Now let's talk about ESAI, which is electronic semiconductors and AI. They custom build solutions, of course, around these, but they offer a wide range of cutting edge products and they offer it to leading semiconductor platforms. Let me talk about some of the platforms they offer it to. Qualcomm, They do system on modules and development kits for robotics, drones, IoT, industrial, healthcare and consumer applications for Qualcomm. For Texas Instruments, again, a cutting edge technology company, radar modules and development platforms for automated robotics, industrial and healthcare applications. That's what they do for Texas Instruments. Lattice Semiconductor, they do data capture, playback module and wave radars for them. NVIDIA, they do AI-enabled solutions for robotics, autonomous systems, ADAS and more. So think about the kind of companies they operate with. These are some of the standout companies when it comes to technology. They are at the fulcrum of huge technology change in the world, not just in India. I will talk about aerospace for a bit as well, because that's the other vertical which I have missed. They do concept design, aerodynamic studies, they do IP validation. They literally break down an aircraft and try to design it better and see where the inefficiencies are as and when they are required to, of course. They do design optimization, that's what it is, and they do evaluation of software as well within the aircraft. So that there's plenty of things that they do. Again, what beats me is the fact that how can you grow at less than double digit when you're in the middle of all of this? So we'll ask that question. Now, in terms of service offering, I'll just now try and break it down and simplify this as much as possible. They do product design, engineering and R&D services. They do embedded software. Some of that is on your screen. Embedded software and hardware system integration and manufacturing engineering. They do digital solutions including IoT, analytics, AI and cloud services, and they do aftermarket solutions and technical publications as well. Let's talk about the business model. They provide end-to-end engineering solutions. They do consulting for each vertical. They do product as well as they do service. They work with global OEM suppliers, defense organizations. DRDO and MOD are just one of the many organizations they work with. We've spoken about plenty of them, including especially in that semiconductor and AI space that they do great work in. Now let's talk about how they make money. Service contracts for engineering design and product development for digital transformation projects as well. So all of those is what encapsulates where they get their money from. Now let's talk about domains, and we've spoken about some of these domains, so it'll become nice and easy for you to look at this screen as to how all of this is evolving. The aerospace domain is largely 30% of what they do. So is defense. So around 60% comes from these two components alone. Then you have ESAI. ESAI is, of course, AI as well as semiconductors and cutting edge technology. There, the numbers are coming down as a component of the top line. I want to understand the growth prospects here. Then there's auto components, which they also do, and then there's energy, which they do. So that's how your entire 100% of top line shapes up. But again, it's going to be interesting to understand how this will move, because this may change dramatically. In terms of geography, and why does geography become important? It's obvious, the tariff problem at this point. You look at Asia Pacific, around a third of the revenue comes from there. USA, around a fourth of the revenue. Europe, around, again, a third of the revenue. And then you have Canada, with a very, very small share. So that's how the geographic split is in terms of this one. Now let's talk about the margins, because where does profitability really come from? That holds the key, right? So you have aerospace, which commands around a 21% margin at this point. Defense is around 15%. ESAI is around 24% in terms of EBITDA margin. Then you have auto, which is -4. So you want to see whether this can improve, whether this can become big, and whether margins can start to come in significantly from here, because this is a 240 crore number where margins aren't coming through. So you want to see whether that can change. And then you have energy, where you have around a 17.5% margin, but the number is so small in terms of contribution to top line. It's not really making a significant dent on that absolute EBITDA number, but this is where the dent will be created. Defense is where the dent will get created. Can these two improve towards 20-24%? Now, so we've kind of covered what the company does. Let's quickly now look at all the parameters that we look for when we're trying to evaluate an Axiscade tech. We look at the income statement, the balance sheet, the cash flow, the return ratios. We look at shareholding, street cred. Street coverage is not there, and therefore we look at outlook and we look at valuations. Again, it's going to be critical to understand each of these individually and then thereafter take a full snapshot at the end and see how it's looking. Let's look at the income statement to start off. Again, it's an impressive looking number in terms of 3-year growth CAGR. It's around 19%. EBITDA growth is around 25%. That number is EBITDA and EBITDA margins. You're looking at net profit growth of 48%. There is two pieces here which I'm concerned about. Your EBITDA number is up 25%, yes, but the EBITDA margin number is at 14%. The guidance is 24%. How do they scale up to that number? That's point number one. Point number two, the revenue growth, while it's 19% 3-year CAGR, you're looking at 1-year revenue of less than 10%. It's just about 8% growth on a 1-year basis. Look at the way the numbers have shaped up, 955 crore in FY24, and thereafter FY25 we've seen it at just 1031 crores. So you want to see whether that number can improve substantially and which year will that kicker come in really, because that's the year you'll be waiting for. So that's how it's shaped up in terms of top line. Now let's talk about the margin picture. The margins have been between the 12 to 14% bracket. It's been 18% in FY23, but broadly in that range. So you want to see whether there is a kicker in which year will that come in. And profit after tax, you see how erratic it is. You're seeing FY23 fall. Now there are one-offs, I don't doubt that. I want to understand, of course, from management whether those one-offs can be corrected. But for the moment, you're starting to see an improvement. So therefore, and the FY26 guidance too is around 160 to 180 crore in terms of profit after tax. So it's going to be a sharp increase from here as well. So I want to kind of figure out as to whether this can continue in terms of profitability and the one-offs can be pushed to the past. Really, that's the question. But let's now talk about the balance sheet, frankly, because that looks decent, in good shape, if I can call it. You look at the net worth, around 350 crore to 650 crore in the last 3 years. You've also seen an equity raise happening at around 658 odd rupees a piece. You're seeing borrowings which are coming down consistently through equity raise and through the fact that there is some amount of decent cash balance which is coming at the end of every year because it's a cash profit which the company is making, and therefore it's headed in the right direction. Fresh investments, where will it come from? How much of that will impact profitability as well as that borrowing number is something that you want to look out for. But for the moment, on a 4,000 crore market cap, you have around a 200 crore of debt excluding lease liabilities. Not looking too bad, right? So that's how I would consider this number. So that's on the balance sheet front. Let's look at the cash flow now. Cash flow is largely lined up with the way in which profitability is going up. So no complaints here. There's a steady increase with regard to operating cash flow. That's what I look for. The net cash flow may be muted because you're seeing borrowings getting repaid, equity issuances happening. So there may be some bit of erraticity in that number. But when you're looking at operating cash flow, it's on an improving trajectory, something that looks good. I want it to scale up fairly significantly, maybe in FY26. And I'm looking for that kicker. And I'm going to ask management whether that will happen or not. Let's now look at return ratios. Now, return ratios are not impressive, frankly. Just look at the way in which return ratios have evolved. This is as per Bloomberg numbers, 11.5% for a company in this kind of a business. You would desire more. So there's much more to be desired with regard to return ratios. Not too happy about it. We believe that this is a thumbs down, and therefore we're not giving this a favorable rating of any sort. I want to wait and watch whether that return ratio number can improve. Let's look at shareholding now. In terms of shareholding, there's a decent amount of holding which the management currently has, and I'll quickly pull that number out. The management holds around 60% even post the dilution that happened in January of 2024. So despite that, you have a decentish holding in terms of promoter ownership, and FIIs don't hold it at all. DIs, there's very little to no participation. The public, though, own a decent chunk. and therefore that's how really the shareholding is shaping up with regard to this one. A thumbs up only from a perspective that there's a strong promoter ownership. You have Jupiter Capital, which is owned by the promoters of Axiscades, which owns around 60% of the company. So again, something to look out for. That's with regard to the shareholding. Let's now look at the street cred. There you go. Look at the 6-month performance, extremely strong. Look at the 1-year performance, even better. The year-to-date performance, 50% plus. No complaints whatsoever. The 5-year performance is even more impressive, 34x in the last 5 years for the company. So no complaints here. We'll have to give this a thumbs up. It's a very, very strong show over the last 3 to 5 years on a consistent basis. So again, that's something which is impressive. Let's look at outlook now. In terms of how the outlook has shaped up, they've guided for 8,500 to 9,000 crore number by 2030. They've said margins will go up from the current mid-teens to 24% at the very least. That's what they're saying. So if you just try and look at the numbers, you have 1,000 crore top line currently, and let me be absolutely precise, 1,030 crore top line currently. On $1 billion revenue number, this will mean that it will have to go up at least 8x. And then you will have a kicker coming from margins as well. So it will be an extremely impressive show if this were to play out. Let's look, therefore, they want to move towards product business. We've spoken about this. They also want to pivot 80-20, which they currently do services to product. They want to move to product. They're targeting a reversal, 20 from services, 80 to product. So that's how it will shift. And they plan investments for developing new proof of concepts and products as well. So we'll quiz management with regard to the capex as well, and that's how it will shape up. Let's look at last off the valuations as well on this one. Currently trades at around 59 times price to earnings. So certainly not cheap by any standard, but the guidance of 160 to 180 crore, and let's assume that they do 150 crore, will leave this one at 30 times 1 year forward, which again doesn't look impressive, but there's a lot to be done, frankly. So we'll give this one a neutral with regard to where valuations is concerned. Quickly looking at all of the ratings as they stack up, let's look at the income statement first. Income statement neutral, balance sheet, cash flow, return ratios. Let's look at shareholding, street cred, no concerns. Outlook is a neutral, want more and want to see how they will execute. And then you have valuations also, which is neutral. Want to wait and watch whether that real kicker plays out. Let's bring on board Mr. Murali Krishnan Desaiyan, who is the Chief Operating Officer at Axiscades, to talk to us about exactly that. Welcome, sir. I want to start off objectively. Why does the FY24 number look sluggish when you have such a strong outlook through to 2029? And what gives you the comfort that you'll do that 8,500 crore in terms of top line by then?
Good morning, Harsh.
Good
Hope I'm
morning,
audible. Thank you, NDTV. Thank you for this opportunity. Thanks for this introduction. Yes, Axiscades is very optimistic of reaching 9,000 crores in 2030, and that is because of the key domains, the core domains that we operate in, and the track record of 3 decades of impressive products that are already developed and matured, and they are in the market. So with all these things, we are only at 25% products and remaining is in service. So we want to flip this and play on our core competence and ensure that our model becomes 80-20. Therefore, we are very confident that we will achieve our $1 billion aspiration and vision.
So why the 8% growth in 2025? What's held you back?
80%. See, last year we have revamped the management, and we started focusing on the core. So while we operate on very many verticals, so there are a few verticals which are niche and which are strategic to the organization. Number one. Number two, so there were post-COVID increases happening in sectors like aerospace, which have come back after a strong dip. And there are some programs which are happening in 2026 instead of 2025 in defense. So this is known fact for us, and we are going to come back strongly in the years coming to come.
So FY26, what will your top line be, sir, and how will the margins evolve?
See, we have indicated our margins are going to grow by 50%, and accordingly, the top line would grow proportionately, and we are very bullish about it.
No, sir. Sorry, I didn't catch that. So top line FY26, what is the number that you're targeting?
See, our core domains are going to grow more than 30%.
Okay.
The defense is going to grow by 35%, aerospace by 35%, and ESAI would go more than 50%.
Okay, understood. So that will take your top line at least to, I would reckon, 1,500 odd crore, if I've done the math right. Okay.
Yes, it would.
And margins, where would margins lie, sir, for FY26?
See, FY26 margins we have indicated, and it is going to go substantially upward. So we are going to improve margins more than 50%.
Okay. Sir, so margins will hit 20%. Would that be right?
Margins would, see, eventually, now it is in teens. Eventually, as we explained, it will go near 24%.
Correct.
So
but
300 BPS would be the annual increase that we are expecting.
For FY26, for the immediate term.
So it will increase by 300 BPS.
Okay, 300 bips for FY26. Understood. And so this 30%, 40%, 50% kind of growth that we're expected to experience in FY26, somewhere closer to 40%, do you expect that that clip will continue to 2029? Will it be a steady 40%? Sorry, will it be a steady 40%?
See, number one, it will be steady increase.
Okay.
So which will give us the 300 points increase. But that won't be adequate for our billion-dollar vision. We would also have step increase, non-linear increase coming from additional areas, such as we are putting up an infrastructure for defense manufacturing, integration, testing. That also includes our ESAI infrastructure. We are coming up with this infrastructure both in Bangalore as well as in Hyderabad. So this infrastructure will help us flip to not only a services company, but to increase our product manufacturing and MRO. So those things would help us do a step change and non-linear growth that would help us push towards billion-dollar company.
Okay, okay. How confident are you of becoming a billion-dollar company, or rather a billion-dollar revenue company by 2029?
Yes, 2030.
How confident are you, sir? Very likely.
So we are 100% confident.
Okay, understood. Talk to me about how the balance sheet evolves. You're saying you're making investments. You've reduced your debt. How should balance sheet look like in terms of debt number over the next 2 to 3 years?
So in fact, though you have shown a debt of 190 crores,
yes.
So we have the net debt of only 15 crores. So
yes.
we have cash in bank, cash, and then also margin monies.
Correct.
So therefore, our debt is very, very less. So our investments for the infrastructure is being funded internally for the phase 1, and we are looking at strategic partnerships for our subsequent phases of investment. So therefore, I would still say that our debt equity ratio will continue to be healthy as we move forward for next 3 to 5 years.
So will you consider fresh borrowing in a large fashion? No. That is the short answer.
Not in large, yes.
Okay, understood. So cash flows, some receivables going up, you work with government entities. Is that a challenge?
It is not a challenge. In fact, if you see, our cash flows has been really healthy. So we have literally no bad debts. And whatever increase in this debtor days is because...
So debtor days have gone up, receivables have gone up, and hence I'm posing that question.
Understood. So that is because of the recent increase in our defense programs, and we have built it in the last few quarters. Right. That will eventually come in the subsequent quarters. That is not a risk at all.
Not a risk at all. Okay. So how much of your top line is at risk because of US tariffs, in your opinion, or is there no risk at all? Because, and I also want to couple that with competition. Is competition very high and therefore is that risk very real?
So US tariffs have not impacted us much
Okay.
because our revenues are distributed. So, and we are also, this tariffs for other countries also is helping us because customers are coming to us for more alternate supply chain and alternate solutions.
Where will your margin accretion come from? Currently you're 20% on your core, but on auto you're on negative. Is that where the margin kicker will come from?
We are already in the process of recalibrating our heavy engineering and auto practices.
Okay.
So we are totally converting that into our core. So
Okay.
that is one of the reasons, no, the margins that are impacted, it is already showing a positive trend in Q4. It will continue to, the impact on this auto and heavy engineering will continue to reduce, and that will convert into our core margins. So we are already in the process of revamping it and recalibrating it.
Very interesting. Thank you so much, sir, for joining us and giving us those candid answers. Of course, extremely interesting company, because if they were to do 8,500 crore in top line, in terms of the way in which at least they're confident and they're guiding, and if they do a 24% margin, that will mean that they do an EBITDA in a single year of 2,100 crore with negligible debt. And they're currently placed in terms of market cap at 4,400 crore. So in the next 3 to 4 years, you want to watch out and see whether execution here happens. That's going to be critical. It's already been a multi-bagger. You want to take care of that as well. Completely out of time on this edition of KYC. From myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.